You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right. Well, interesting Fed meeting yesterday. So I saw an interesting blurb on Twitter about the fact that after the Fed meetings, the last, I should say all the raises, when it has been anticipated that the Fed was going to raise interest rates, that the market actually responded positively. And the market did do that yesterday. Now, at this point in time, we are taping Options Playbook Radio. It is Thursday, September 22nd. The market is open and rocking and rolling. And it's the day after the Fed has met. And at this point in time, the markets are a little scary. Once again, we're in September, and we're also approaching October, two of the most volatile months in the marketplace. And we have the S&P 500 index down 24 today, trading at 3765, around there. As I said, the markets are open, so they are moving. And we did get the jump up in the VIX. The VIX is trading around 28 level, which actually, in a weird way, makes me feel more comfortable that the VIX is actually acknowledging the fact that there is some risk that is in the marketplace and adds some risk premium to the option contracts in the S&P 500 index. We have the Dow Jones Industrial Average is down 121 points, or about 0.5%. And we have the NASDAQ once again leading the markets lower, down 1% at this point in time. I shouldn't actually say the NASDAQ's leading it. The Russell is actually down 1.65%. So markets they reacted a little positive to the fact that maybe it was a 0.75 point hike as opposed to a 1% hike. There was, going into the Fed meeting, about the Fed Watch tool on the CME was showing about an 18% chance that they were going to raise it to a 1 point as opposed to 0.75 point. And that's based off of the prices in the futures. Okay, so I think that's enough about the markets. I'm still, we're still in September, still want to stay bearish. That's been the theme. Last week we went and looked at Meta. And, interesting enough, in Meta, we did a bear put spread. That means that we bought the more expensive put and sold the less expensive put option, wanting Meta to go down. Meta did go down, and a lot of the market went down. And before that, we looked at the QQQs. The reason why I'm bringing the fact up that we did a bear put spread is, if you are bearish on some of your tech stocks, if you are, I would say bullish but nervous. Let's change that around. And you have 100 shares of Meta, or you have 100 shares of Apple, Google, Netflix is going to be our theme today. If you have some of these stocks and you do want to protect them, instead of buying puts outright, you can go back and listen to the Meta conversation that we had last week. Well, just think about a bear put spread or a put debit spread as an alternative. So you're just basically protecting yourself for a range. And the fact that implied volatilities are high with the VIX at 28%, that means a lot of the stocks have higher implied volatilities. A great alternative to just buying a put outright is to protect yourself for a range by doing a long put spread. So for every 1-by-1 put spread, that would be done to protect 100 shares of that underlying stock. Excuse me. So in that theme, that's what we would be looking at, is going out and buying that put spread as a protective mechanism for some of the stocks you may own. All right, so let's look at last week's trade. It's going to be short and sweet because usually if the stock goes the way that you would like it to go, it's a very simple conversation. Last week we looked at Meta. Markets were closed when we taped Options Playbook Radio. Meta was trading around 151.47. We straddled the market with our long put spread and with the intent of trying to buy about the same amount of time premium as we're selling. And whenever we do that, you usually end up with about a 50-50 risk. In other words, if it's a 10-point wide spread, you're going to pay close to $5. If it's a 5-point wide spread, you're going to pay close to $2.50. And that's one thing that's wonderful about put spreads or call spreads, nonetheless, if we're doing it on the long side. When you straddle the market like that, you're basically going to make it a 50-50 type trade, in that either I'm going to lose my premium that I paid for it. In this instance, we're going to pay $4.40 for a 10-point wide spread, or I'm going to make about that amount if my forecast is correct. And on the upside, on a 10-point wide spread, you would make $5.60. And it's just all about how time premium works in the options and how they are priced. Usually equidistant in the money and out of the money, you're going to have the same amount of time premium. So you're going to be buying some intrinsic value, some time value. The amount of the time value is going to be very close to what you're selling when you straddle the stock price. Okay, so Meta was at 151.47. We bought the 155 strike put and at the same time sold the 145 strike put. Now, the perfect situation would have been if the stock was right at 150, right? Then we would be exactly straddling the marketplace. It was at 150, 147, but we were still able to get it done for a decent risk reward, in that we would be paying at the midpoint last week $4.40 plus commission. That's $440 for every 1-by-1 spread that we did. And we would have the upside of $5.60 on that 10-point wide spread. And so that would be $560 less commission would be our max upside on the trade. And if the stock just kind of stayed where it was at, well, we would actually have a little bit of a profit on this trade. It would have been very, very close, just a smidge. But we were basically saying, because of the way we managed our time premium, that if the stock just stayed where it was at, Meta or Facebook, then we would have broke even on the trade. Well, the stock went down. So Meta is trading at 142.59. It's bounced a little bit, but it definitely made a break to the downside. Now, if you go back and you look at the Meta chart, it's very dramatic. Let's put it that way. You go all the way back to March 18th, and that's when Meta actually hit a low, a more recent low. It basically filled a gap in the chart and then bounced. And it bounced hard to the upside. Ran basically from 137-ish all the way up to 375. Now, that was March 18th of 2020. That is when we still had the pandemic going on, and we skyrocketed to 375, and now we're all the way back down to that level, with the stock trading right around 142.54. So that is obviously a level to target. If you look on the chart, it is fairly obvious that that level is an area of support for Meta as far as charting is concerned. We've gone two long put spreads, the last two option playbook radios for that reason, I'm not going to do a rinse and repeat again. Both of those trades worked out just fine. And as always here on Options Playbook Radio, nothing that we talk about is meant to be a recommendation. We always call them paper trades for a reason, because we should be trading them on paper, and we're just trying to learn here and apply strategies that work in the current market conditions. So you're just trying to learn how to take a strategy from the options playbook and apply it to this underlying. There's no golden book of answers as to what the best strategy is every time that you're placing a trade in the options world. You got to look at where implied volatility is at, what's going on in the marketplace, and then make that decision. All right, so this week, let's stay in the same world, and we're going to be bearish again, but I just figured I'd change it up, and we will do a short call spread. Now, if I'm doing a short call spread, I am bearish, but I'm going to give myself a little bit of a leeway. The risk reward isn't as impressive on a short call spread comparative to a long put spread like we did last week in Meta. We're going to be selling an out of the money short call spread, saying that we would like the market to go down or just basically stay where it's at and try to make our profit that way. So we're doing it all about time decay. So I'm going to take another one of the weaker FANG stocks, and we're going to look at Netflix this week. Part of the reason why is that, well, Netflix is a little bit more expensive stock, and there's some good premium in Netflix because of that. And we see right now that we have Netflix trading at $235.99. We'll call it 236. As I said, the markets are moving. And I'm going to show you how I would set up this short call spread to get bearish on Netflix yet again. And I'm going to use the last expiration in September, which is the September 30th expiration. It's 8 days away. So September has proven, the month isn't over with yet, right? But year in and year out, September has a tendency to be the weakest month of the year. And this year they didn't disappoint. We looked strong at the beginning of the month, but now not so much so. And especially in the tech stocks. The tech stocks are taking the brunt of the September woes. So stock at 236. First thing that I want to look at is, what is the most at the money straddle trading for? And when I'm looking at short now, so here's something about pricing. Okay, so we're going to learn something about pricing, or we're going to have a discussion on it. Maybe you already know it, but we're going to have a discussion about pricing. When I'm looking at doing a short call spread or a short put spread, I'm going to try to focus the strike of my short option contract at least the expected move away. And there are some things to make sure that while you're doing this, that you are getting the expected move away. Okay, so the most at the money option contract is the 235 strike. I'm looking at that. I'm seeing an ask of around $8. Market is moving on the call on that strike, and the put is around $7.50 on the ask. So we'll call it, those are the asking prices. We'll call it $15. It's not an exact science. The markets are moving. And so $15 on an expected move means that we're going to be right around that 250 level. Now, you can go a little bit further than what the marketplace is expecting the move to be. And all you're doing is just saying that, if I bought the long shot, if I bought the call, I bought the put, the market would have to move approximately that amount, but not approximately, it would have to move that amount by that expiration date in order to have some profitability on that trade. And the market refers to that as the expected move. You're using the prices of the options to see what the marketplace is implying the move might be over the next 8 days. Okay. Now it's finishing. It's not saying that it could go way up, could go way down, but when you look at expected move, it's the probability of it finishing above more than 15 points above where the current stock is trading at, or below. Never has any regard to direction. Okay, so I'm going to sell the 250 and I'm going to buy the 250 here. Now, I'm only going 2.5 points wide, because usually if I'm talking about this on Options Playbook Radio, I'm going to try to minimize that risk as much as possible, because we're just, once again, learning. I personally might, if I was in my own account, I might do a 5-point wide trade, but I'm okay with going 250. And if you do move the expected move away, you're going to have a delta that's going to be fairly close to 20. And it's all about probabilities, because delta is based off of probabilities of the stock making that type of move. And that's how they come up with the delta, which will determine how much your option contract will move for a 1-point movement in the underlying. But it's more so about the non-textbook definition. That delta is the probability of the option contract finishing 1 cent in the money on expiration. So it's always going to be right around 20 if you go at least the expected move away. And that means that there's an 80% probability that the underlying stock will be below that level. It's that simple. And also, if you do this, if you're doing a $2.50 wide trade, well, then that trade should be selling for around 50 cents. And it, once again, has to do with probabilities, the probability of that stock reaching that level. And so if you always set up your short call spreads in this instance that way, you're almost always going to see, especially if you got odd situations that can come into play, like short interest stocks really heavily shorted, or mergers, acquisitions, things that might mess up the option pricings. But if it's a very liquid underlying and like Netflix is, and you're doing this type of trade, if you're going 2.5 points wide, you should expect to get around 50 cents net credit to your account. If you're going 5 points wide, you should be able to double that, and you should be looking to get about $1. Then that means that on a dollar if you take $1 divided by 5, that means that you're looking at a 20% chance of that underlying reaching that short strike and finishing in the money. And it's weird how everything is tied in together. If you take 50 cents and you divide that by 250, the maximum risk, you're also going to get 0.20 or a 20% chance. And hence the delta is a 20% chance. So this is the one thing I love about option trading, is that it has nothing to do with the outlook as far as the option prices are concerned. They don't care about the management of Netflix, of the fact that Disney is their competitor, that Amazon just went out and did Thursday night football and received a whole bunch of Prime memberships because of it. They don't care about that. All the math, all the option contracts care about is the math, and that's why they are priced accordingly. Everything is tied in together. So I guess that's the moral of the story. More so today I kind of went down the option pricing road, because I just think every once in a while we should chat about that. So here's our paper trade for this week. Netflix trading at round up a little bit, 236. Markets are rocking and rolling. We're going to look at the September 30th expiration, 8 days away. We're going to be selling the 250 strike call, and at the same time buying the 250 strike call. We're going to be doing this for a net credit to the account of 48 cents. Now, it actually wasn't that close to that. So the market has moved, and maybe the option pricing gods were listening to my podcast, but right now the midpoint is exactly at 49 cents. And I just find that interesting that we were doing that math situation. And literally the math worked out that way. So it's right now we're going to call it 49 cents. If we can fill it at the midpoint, it's never a guarantee of a midpoint fill. That means that if we round that up to 50 cents, our max risk would be $2. Our max upside would be 50 cents. And that would be 50 cents less commissions for every 1-by-1 spread that we do, or $50 less commissions would be our maximum upside on that trade. If the market does go down and it does it fairly quickly, if I can buy this back for a dime or 15 cents, I'm going to do that. If the market goes against you, you need to make a plan right now. A lot of people will say on my short put spreads or my short call spreads, my maximum I could make is 50 cents. So if I lose 50 cents, I'm going to get out. Some people will just let it ride, but that's not a bad formula. It's trading for 50 cents right now. Market goes against me. I would go in and buy and close that position at $1, hence meaning I lost my 50 cents on that trade and live to see another day. All right. That's it for this episode of Options Playbook Radio. If you have any questions you'd like to ask, please send them to me directly at theoptionsguy@invest.ally.com. If you'd like to learn about all the educational events that we do here over at Ally Invest, best thing to do is to follow me on Twitter. My handle is very simple. It's at my name, which is Brian Overby. Thanks for coming, everyone. And we'll see you same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.